What's up, guys? Joe Fileman here, back with another installment for my channel, Rollin' in Crypto. So, as of late, I've been getting a lot of requests for me to bring some of my trading tip videos back because I've spent a lot of time delving into different projects and talking about market updates for BTC. But some people have been asking me to bring back some of the more simple trading tip videos that I was doing when I originally started the channel. So, as you guys can see, first and foremost, we got our new camera here. Nice quality, a little bit better quality than the one that we've been using recently. But on to what we are going to be talking about today. So we are going to be talking a bit about the exponential moving average and the standard moving average or simple moving average. So realistically, there isn't too much deviation between these two. A lot of people have asked me on stream recently why the simple moving average has a bit different settings than the exponential moving average. And really the most important thing to know as far as the way that these two react to each other is the exponential moving average takes in a bit more of the most recent data and weighs it more heavily than past data. So really quick here, we have our simple moving averages right here. We can see how they react to our price. And if we pop on our exponential moving averages, we can see that these hug a lot more closely to the actual price, and that's because obviously it's being weighted more heavily due to the newest price being used. So in my opinion, I personally like to use the exponential moving averages more than I like the simple moving averages, and that's more generally because I do intraday trading more than I do on the longer term. I think on the longer term, you like to look at a conjunction between a momentum indicator with the standard moving averages, and that's because obviously you're using more data with less weight at the current levels when you're using those moving averages. So really quick, two things that you should know about when looking at these moving averages, and just to teach you really quick how it works, we're looking at the hourly chart here, so we'll look at the exponential moving average. So we can see that we're hugging closely here. And you have three lines that I generally use. You can set these to whatever time setting you would like to use, but I use the 50, 100, and 200 as my data sets for what these moving averages are used for. So essentially the gold is my 50, the green is 100, and the red is the 200. So here we can see that our 50, which is our smallest term moving average, essentially the least of the data sets used in this example, is crossing up at this point down here at our 6K level and coming up through our different points here. So when we see this, our gold line here, our 50, which is our shorter term time frame, coming up and pushing through our longer term, this gives what is called a golden cross. A golden cross is when you have your shorter term pushing up through your longer term, and it's coming from a bearish trend and starting to reverse to a bullish trend. And here on BTC, we can see this happening a few different times. And where it's most prevalent is when we had this huge run up down here from about 6K-ish and pushed all the way up to the top to our 20K run. You can see here that we were golden crossed the entire time that we ran through this period. And only when we death crossed back through here, we saw that we were actually starting to come down more. So this is a simple method if you're new to trading and technical analysis you can use to trace actual market momentum and see where pretty much the median lines of all of these different price action charts and things of that nature are actually moving to. So in my opinion, exponential moving average, because it uses more weight at the current time scale, is more important on intraday trading than it is for longer term charting of trades where you would want to see the more simple moving average. So the first one we talked about is the golden cross, how we came up through. The other side of it is a death cross. A death cross is when you have your 50 coming through your longer term moving average. And this can be true of just about every different moving average that you use. You can set it to 7 and 21, any time frame that you want. As long as your shorter term is pushing up through your longer term, it is considerably a golden cross. And if your shorter term is coming down through, then it's a death cross, as we can see right here. So here's a perfect example of a death cross. And here is the most prevalent example we've seen on BTC for a golden cross. And so if you're new to technical analysis, I definitely would say turn these on and follow them because it will help you understand how price action works. If you enjoyed this video and you want to learn more about technical analysis, please do not hesitate to jump into my stream. I love to teach technical analysis, guys. I do this full time. I'm a day trader. I've been trading Forex, equities, as well as getting into cryptos early this year for a number of years. And I love teaching everything that I've learned, and it helps to get you up to the level that I am at in this day. Thank you guys for tuning in, and comment what your favorite technical analysis tool is below. Thanks, guys.